Are you curious about how stock markets can create wealth for long-term investors? If so, you've come to the right place. This video will explore why investors must make money on stocks over time and how stock markets work. Whether you're a seasoned investor or just starting, understanding how stock markets can create wealth is essential to your financial success. Hi everyone, Patty Z here with the 3-Minute Money Channel. In today's episode, I'll explain why investing in stocks creates wealth for long-term investors. Let's start with a brief definition of stock markets. These exchanges, commonly called stock markets, are organized worldwide supermarkets where publicly traded companies' shares are bought and sold. In the United States, examples include the New York Stock Exchange, or NYSE, and the National Association of Securities Dealers Automated Quotation System, or NASDAQ. At the same time, internationally, it would be places such as the Financial Times Stock Exchange, FTSE in London, or the Hang Seng Exchange in Hong Kong. These marketplaces offer individuals the freedom to buy and sell shares of companies they want to own or divest themselves of. Each stock exchange commonly comprises thousands of companies, and the value of each share represents a fraction of the ownership value of that company. The price listed on any stock exchange is the deemed worth of that particular share as negotiated between two independent parties. It is considered its fair price or equilibrium price for that specific share. However, this price is not fixed. It can and does fluctuate due to various factors that influence the supply and demand of the share, such as company performance, economic conditions, and investor sentiment. Despite the volatility of stock prices, investors still choose to invest in stocks because, on average, they generate higher returns than other investment options, such as bonds or savings accounts. In finance, this is known as the equity premium, which is technically the extra return investors expect to earn from stocks compared to other low-risk investments, such as United States Treasury bonds. The equity premium is the compensation investors receive for taking on the risk associated with investing in a stock market. Stocks are known for their volatility and the potential for a significant loss of value, so investors must demand higher returns than other low-risk investments. Risk must equal return. In other words, investors must be compensated for taking on the extra risk, the greater risk, and the equity premium just mentioned reflects that compensation. Historically, the equity premium has been significant, so stocks have generated high returns over the long term. According to a study by Ibbotson Associates, a financial research firm, the average annual return for the U.S. stock market between 1926 and 2020 was around 10%. This is substantially higher than the average return for bonds or savings account, which was about 5% during the same period. However, it's worth noting that investing in stocks does come with risk, and there's always a possibility of losing money, especially in the short term. Investors must understand their risk tolerance and have a long-term investment horizon to benefit from investing in stocks. In conclusion, the equity premium is why stocks commonly work to create wealth for long-term investors. While investing in stocks can come with the risk, the potential for high returns over the long term makes it a popular choice for investors to grow their wealth. Now, before I go, and notwithstanding the veracity in all of what was said above, I do want to point out two major impediments that any investor must consider. First, stocks bounce. And when they bounce, many people can't handle that impact emotionally and leave the market. That psychological impact is daunting, and it's why the average investor gets 60% less than they deserve. They do sell low, and they do buy high. Secondly, when I say stocks go up, I mean in total. The system of capitalism means that any company can go broke at any point in time. That's the risk equals return element that I said earlier. Every company president thinks their company will be the next Microsoft or Apple. Still, if you look at the long-term historical data, you will find that only 4% of all companies are the ones that pull the whole category up, that pull the stock market up. That means finding that winner is a needle in a haystack challenge. That's why I recommend broad-based index investing as your best approach. See my video on that subject to get smart on the best way to invest. Thank you for watching. And I hope you found this video informative. Please give it a thumbs up and check out my other videos. Until next time, I'm Pat Zumbush, your YouTube CFP. As always, thank you for letting me help you do wise things with your money.